You're listening to Angel Insights, brought to you by SyndicateRoom. This is the show that takes you inside the world of the greatest angel investors to reveal their tips, tactics, and investing experiences. And today, we bring you an incredible investor in the form of Ben Luntz. And Ben has really experienced it all on both sides of the table, having been an incredibly successful entrepreneur with the acquisition of his company Apex Exposure. Ben started making angel investments, and born was his passion in investing and working alongside startups, up until today, where Ben is now managing partner and co-founder of Indicator Ventures, an early-stage digital venture fund in New York City. But before we dive into the show today, a dear friend of mine and the show, Brad Feld, has very kindly suggested a book giveaway to listeners of Angel Insights. So for the chance to win a signed copy of his best-selling book, Venture Deals, all you have to do is click the Click to Tweet link in the iTunes description or on the website at www.syndicateroom.com, and once you have tweeted this, you will be automatically entered into the competition. So do it now and win this unbelievable prize. Signed copy of Venture Deals by Brad Feld. Can't miss it. But now it's time to head back to today's show. So ladies and gentlemen, it is with great pleasure for me to welcome Ben Luntz, managing partner at Indicator Ventures. Ben, it's an absolute pleasure to have you on this very special episode of Angel Insights. Thank you so much for joining us.
It's truly a pleasure. Thank you for having me, Harry.
Now, I'd love to start off by hearing, how did you get into investing?
So for me, it was very much a natural progression of events, and it started with having founded my first company about 9 years ago. After having spent a number of years working in the advertising agency business, I decided that I was going to go off and start my own agency. And in large part, this was driven by what was happening in the broader market at the time, specifically with the emergence of social media. There were platforms like YouTube and Facebook and Twitter that were popping up and creating a tremendous amount of value. And I said to myself and to my partner at the time, you know, if we could go and build an agency that could help brands navigate this incredibly complex yet incredibly powerful medium, I think we're onto something. And so that's what we did. And we did it really with no plan. We started out of his apartment in Brooklyn. I funded the business, or we funded the business ourselves. And we just started to pick up the phone and dial. And 4 years later, we ended up selling the business at the time to Big Fuel, which was later acquired by Publicis. And, that sort of brought me into an interesting situation where, so at Big Fuel, at the time, we were the largest social media agency in the world. And
Wow.
One of our largest clients was General Motors.
Congratulations.
And we were tasked.
That's unbelievable.
Yeah, it was an exciting time. And we were tasked with helping to deliver earned media at scale for them. And so in order to do that, we had to go and find the next great emerging digital media platform or ad tech platform or influencer platform. And so by virtue of that, I was spending a lot of time reviewing and understanding many of these emerging startups. And I also had a couple extra bucks in my pocket from the acquisition. And so I took this as an opportunity to sort of dip my toe in the water as an angel investor. And the first company I invested in is a company called BuzzTable. They are a mobile CRM platform. If you ever go to a restaurant and they hand you one of those clunky buzzers while you're waiting for your table.
Yeah.
Well, BuzzTable is essentially that. And the concept is, well, why do you need an antiquated plastic device that's the size of a hockey puck in your pocket? You already have this beautiful phone. Why isn't that the buzzer? And that becomes a platform for two-way engagement and a bunch of other things. So I work very closely with that business and help them with everything from fundraising to strategy to product positioning, and it went very well. Long story short, we ended up selling the business to Cisco. And so I think it was that experience for me that really was the catalyst to grow, not only and develop this practice of investing into an institutional organization, but to continue to do more of it. So I did just that. I began to deploy more capital, and I began to understand, the types of things to look for. And I began to develop a network. So, I was able to, to have, access to great deals. And I was doing a lot of that, so much so that I felt that I was overextending myself personally. And again, the natural progression was really to institutionalize it and to start a fund. So I'd be happy to talk more about how that came together, but I'll stop for a second if you have any questions.
And so, having been a successful entrepreneur there, as you said, prior to your investing career, that is, how do you think that has influenced your approach to startup investing and founders, would you say? And do you think all VCs should have this experience of being an entrepreneur?
That's a great question, Harry. I think yes and no. So yes, I think for me it's benefited tremendously. I've always been someone that learned more through doing things as opposed to observing or reading about them. And so, for me to have the hands-on experience operating a business, navigating the trials and tribulations of trying to grow the business and eventually exit, I learned a tremendous amount. And those are all learnings that I leverage today, not only in helping to evaluate the various investment decisions that we're making on behalf of the fund, but moreover, once we've actually written the check, and frankly, we believe at Indicator Ventures that's when our job starts, is helping to work with these entrepreneurs and to navigate what at many times is often the most fragile time for that company, and that is seed stage.
Absolutely. And do you ever maybe feel that there are any negatives concerned with having that operations experience, potentially being aware of the pitfalls that might lie ahead and then, being too reserved?
Yeah. Short answer is yes. I do think that there are some negatives, but I think only if you let them get in the way. For me anyways, and I'm speaking through the lens of my own personal experience, oftentimes I feel like I know the answer ahead of the entrepreneur, and it takes a lot to resist blurting that out. In many cases, you want the entrepreneur to get to the decision on their own. It's a lot more impactful that way, and moreover, if you're constantly helping them to get to the answer or giving them the answer, it promotes a culture of laziness in some ways. So I think short answer is yes, it can get in the way, but only if you allow it to. And I think that as long as you are very thoughtful and you work very closely with the entrepreneur, you let them do their own thing and run their own business. We like to talk about providing very, very strong opinions or points of view, but we always say that they're take it or leave it, and that's really important for us.
And having been an entrepreneur to successful entrepreneur and investor to a full-time investor to now a VC, how have you seen your strategy in terms of investment strategy alter over time?
Well, I think with anything, more experience brings greater understanding, whatever it may be. And so, I think certainly one thing that I've benefited, and I know that my partners have benefited from, even in just the past 2 years of having launched the fund, we're able to understand what we like and what we don't like, what we're looking for and what we're not looking for more succinctly. And in turn, that helps us get to an answer more quickly. And that's incredibly important. Being able to tell an entrepreneur yes or no quickly saves a lot of time, and so I think that's one area where we've certainly optimized. And I would add to that part of the manner in which we've been able to do that is through implementing greater process and structures. So as we evolved as angels, and not just myself but my two partners, Jeff Bernstein and Jonathan Struhl, We've evolved our diligence process. We've refined it. We've structured it more, and again, it's more optimized in terms of us being able to understand the types of things that we're looking for, and perhaps more importantly, the types of things, the red flags that we like to avoid.
So, what does the optimized, structured diligence process look like now?
So, in many ways, it's driven by and housed in a tool that we've built through one of our portfolio companies. So there's a company by the name of Shibumi, and they've built what they refer to as an initiative management platform for large organizations that have multiple different inputs in terms of information that all ladder up to one shared goal, in many cases overseen by a singular manager or a small management team. And we've taken this and we've used it to create a template for ourselves to help streamline our diligence process. So it starts with an executive overview and then goes through into a long list of due diligence items, what we refer to as our checklist. And then that flows through into a deal memo and or a pass memo. And so, again, being able to structure it helps us to streamline the process. It also helps us to go back when we're looking at historical data. It's all there contained in a nice, neat archive. And so that's also been really helpful for us as well.
And you said now you can, with this streamlined, optimized due diligence process, you know succinctly what excites you and what is a yes and then what is a no. So what metrics lead you to get excited? Is it kind of downloads, retention? What is it for you?
That's a great question. Well, of course, it depends on what we're looking at. So if we're looking at a consumer app, then yes, of course. Downloads, retention, and engagement are certainly very important, and general growth of those metrics. Let me just rewind for a second. I think, generally speaking, it's very important, and we're a seed stage fund, so we're always looking at companies very much at their infancy. It's still important for us that the company has a product. There are very few times that I can recall, if any, where we're able to get over the line on just an idea. Obviously there are factors that can make that type of decision more complex. So if you're dealing with a very exciting, very successful team that has a history of working together and building successful products, that makes it more compelling. And okay, fine, maybe we'd be willing to make an exception. But generally speaking, having a product is incredibly important. And so what follows from that then is metrics and traction around that product. So again, like you said, if we're looking at a consumer app, it's going to be more downloads and engagement and retention. If we're looking at an enterprise product, we're going to be looking at their sales cycle. We're going to be looking at things like churn. We're going to be looking at the lifetime value of the contract and other metrics that surround that. If we are looking at a physical product, we might be looking for reviews, user testimonials. If we're looking at an ad tech product, we might be looking at traction in the marketplace. Not only just general trends that speak to the direction that the broader market is moving in, but perhaps moreover, on a granular level, what type of traction they're seeing from a sales side. Do they have early customers? Are we able to interview those customers? And what do those customers say about this product? Is this something that is not only an important part of their business, but ideally a critical part of their business? Is it something that they would be willing to recommend to their peers? If so, why? Is that something that they've already done? So those are the types of things that we look for. And in fact, those are the types of things that we call indicators.
And at this very early stage of the funding process, it's quite traditional for several angels or seed funds to syndicate the raise for the startup. So what inspires confidence in you when you see the names of fellow investors? I mean, what do you like to see in your co-investors?
Great question. Yeah, so it starts with people that we know, and I would weight that more so than I would big brand names. And that's not to say that we wouldn't love to be invested side by side, a Greylock or a Sequoia or any of the big brand name VCs. But and in many cases we are. However, for us, what's more important is knowing that we understand the team that we're going to co-invest with. Ideally, we have a relationship, or even better, a history of having worked together. So we understand how they think. We understand how they think about not only specific broader market conditions, but how they think about working with a business, how they think about working with a founder. For us, we're pretty hands-on, and I would say very hands-on in some cases. And so it's important that we're going to invest side by side with a fund that wants to participate in that nature. And again, also a fund that takes our approach in terms of being very opinionated, but at the end of the day, understands that it's the founder's business and that we're investing in them and their vision, and that it's important for us to play a supportive role as opposed to a directly controlling role.
And I'd love to delve into a good old war story from your investing days now. What went wrong and how your approach or strategies changed as a result. Could you give us a little war story?
Sorry, Harry, no war stories. Everything's just peachy in the VC world.
Oh, that's very nice. Congratulations. Next question.
No, wouldn't that be nice? Let's see. Well, gosh, there's quite a few, and I have to be careful about what I say and don't say. I guess I'll speak to something that we're dealing with or dealt with recently with an existing portfolio company, and I'm not going to name any names, but
no names.
This is a company that is doing something very interesting, and they're attacking an industry that's is relatively antiquated. It's a very large industry. In fact, it's still growing. 10% year over year, multi-billion-dollar industry. But for whatever reason, it's a dirty word in the VC world. So they've had a hard time getting funding. Meanwhile, we love their model and we invested in them early on. We love their team. We love their partners. And so we've been helping them to scale their business. And we've done so, I believe, successfully, despite being undercapitalized. So because they're in this difficult industry, they've had a tough time raising money. And they made an investment about 3 months ago, which ultimately I believe was a good investment to make, but it meant that their cash runway was now much shorter and they had to go raise money. And they're having a difficult time doing that. In fact, so much so that their founder called me and said, I'm not sure if we're going to be able to do this. I might need to go look for a new job. And, that's a very, very, very scary thing to hear. As a VC. And for us, we understand that there will be losses. It's part of the game. It's part of the world that we live in, especially with seed stage, but it doesn't make it any easier to swallow. So I said to him, listen, why don't we take a different look at this business? Why don't we talk about it differently? And let's position it differently. And we'll do so in all of our materials. And we're going to go out and we're going to reattack this thing. And in the meantime, why don't we go to our existing investors and say, listen, we're requesting that you follow on with 10% of your initial capital. And I think that was something that was smart that we did. And from what I gather, 98%, if not 100% of all investors followed on. And I think that makes sense. It doesn't surprise me. If they invested in the business initially, they believe in the model, and to add an additional 10% shouldn't be a big ask. But for the business, it created a tremendous amount of breathing room. So it bought them another 2 months. And within this period of time, they were able to recalibrate their message, recalibrate their approach to fundraising, and they've had a tremendous amount of success. Moreover, they've also, in their repositioning, been able to generate a significant amount of interest from potential partners. One of those partners has now expressed interest in acquisition. So we're certainly not out of the weeds in any way, shape, or form with this business. But I think taking a step back, taking a fresh approach, looking at it a little bit different way has helped tremendously. And in turn, by going to the existing investor pool, asking for this small follow-on commitment, in effect, creating a little bit more breathing room and allowing the time to be able to go and explore these options has paid dividends. And so I think that's a good example of a war story, at least that I can speak about.
Fascinating turnaround there. And congratulations to you for leading the turnaround.
Thank you.
And we're going to delve into a quick fire round now where I say a short statement and you give me your immediate thoughts.
Certainly.
So your favorite investing or tech-related blog, podcast, newsletter, what would it be?
That's a difficult question. I read a lot of
resources,
stuff.
Yeah.
Yeah. I would say I really like CB Insights. I just think that the tone is spot on. I don't always agree with their positions, but I really enjoy reading what they write. And, I follow a lot of different blogs and podcasts and, thought leaders. Theirs is one that I almost always read.
Fantastic. Absolutely agree. CB is great. And we actually interviewed Anand on our sister show, the 20-Minute VC, and that was fascinating to hear his startup journey.
Very cool.
And then the biggest misconception about early stage investing?
The biggest misconception? Well, there's a lot. I'd say one that, and people are going to argue with me on this one, it's not as risky as people may think. And, I often get into debates with people about this quite often, especially when people bring up the philosophy of, oh, yeah, well, early stage venture, it's just spray and pray. And I think my partners do too, really take offense to that. We take a lot of pride in what we do. Yes, it's a lot more difficult. There are less metrics to decipher, but I think in many ways that's also why it becomes an art. And so, yes, I think if you're doing it thoughtfully and you're good at it, that it's a lot risky than people tend to believe.
And then your investing ethos in a sentence.
I'll give you less than a sentence. Digital efficiencies.
Fantastic. And then what are the must-knows to individuals starting out in the investing game?
Starting out on the investment side or as an entrepreneur?
On the investment side.
Don't overload yourself. I would say, you'll see a lot of deals to start, and I think you'll be very excited by a lot of those deals. I think, having the discipline to be able to pass and to wait and to be patient for, the right deal that is really, really exciting and makes sense on a number of levels. I think that's really important. I know that there were a couple of deals that I rushed into early on as an angel, which I probably shouldn't have. But at the same time, you also learn more from your mistakes oftentimes than you do from your triumphs. So I guess it's not bad to make a mistake here or there as well.
And then what is your most recent investment and why did you say yes?
Well, if follow-ons count, I would say technically my most recent investment was a follow-on where we led the Series A for a phenomenal company called Bond, B-O-N-D. Bond has built a suite of hardware and software products that allow people to distribute handwritten notes at scale. And we decided to participate in this round really just because of the traction. This is a company that we invested in about 10 months ago initially, if I'm not mistaken. And we invested really in a vision, a grand vision, and a founder and a team that had done a lot of things to bring this vision to life. And there was some early traction, enough to get through our diligence process, but we always love when a founder says that they're going to do something and then does it, and not only does it, but does it with great success, and ideally does a couple other things too. And in Bond's case, they've done exactly what they said they were going to do and more, and their future looks incredibly bright.
Well, Ben, thank you so much for coming on Angel Insights. It's been an absolute privilege having you on the show.
It's really been my pleasure. Thank you for having me, Harry.
For all the items mentioned in today's show with Ben and the accompanying article for the show, head on over to www.syndicateroom.com and don't forget the amazing book giveaway. A signed copy of Venture Deals by Brad Feld could be yours. All you have to do is click the click to tweet link in the show notes or on the iTunes description. Thank you so much as always for your continued support, and we look so forward to hearing your thoughts on today's episode.